Okay, it's a great pleasure to be here. Let me start off by explaining to you first what G20 Sherpa is about. G20 Sherpa is essentially a representative of President Park at the G20 issues. So what I do is, what I did, because I actually finished my term as the G20 Sherpa last month, is I represent Korea at the G20 level discussions throughout the year. Prepare for the Leaders Summit, and then once a year I accompany our President Park to G20 meetings, explain to her what we have discussed, and I was going to say what she's supposed to say, but that's not really correct, because throughout the year she gives me directions as to what I'm supposed to negotiate, so it's essentially a sort of a circular thing. And then I also I used to hold regular meetings among ministries, because there are many G20 issues that touches upon various ministerial level aspect that has to be agreed internally. So I used to chair the interministerial meeting consisting of assistant ministers. There we get some form of agreement, and if we can't agree on something, then I used to take it to the top level, and then she used to decide for us. So at the beginning of the year, of course, I get direction as to what issues I should discuss and what issues we should pursue for Korea. So what I'm going to discuss today, or rather not discuss, but present to you, is Korea's G20 strategy over the 2 years during which I served as the G20 Sherpa for Republic of Korea. I feel much more flexible now and free to discuss about these things because, as I mentioned, I'm no longer the G20 Sherpa as of last month, so nobody can actually fire me anymore. For your background information, there has been 3 G20 Sherpas since it actually began in 2008. The first person is in the United States at the moment, and second person is actually a professor of this university in economics department. I don't know whether you know Houng LEE, and I'm the third G20 Sherpa. So it doesn't really mean much. I just wanted to tell you that one of the Sherpas is actually, you may be listening to his classes, for all I know. Okay, let me now start. G20, what is it about? Well, you may have heard about the 2008 global financial crisis. What it was much bigger than a simple, normal banking problem, because it undermined the very essence of what we would describe as the fiduciary system of our economies. So what fiduciary system is actually the rules, unwritten rules plus written rules of how we conduct businesses, how we write our contracts, and the fact that we actually have to honor our commitments among ourselves. The whole system, the whole package is what we would call the fiduciary system of our economy. And it goes in parallel with the real economy. So the real economy cannot operate without this fiduciary system underpinning all the transactions that's actually undergoing the real sector. It's the payment system and so on. And during the global financial crisis, the very foundation of this fiduciary system was threatened because the degree of the crisis was so severe that everybody was fearing that the US financial system might actually melt down. I was at that time in the IMF in the middle of Washington, D.C., and I was so concerned that I almost went to the bank and withdrew all my money, deposits, because I wasn't sure whether the banking system would actually last for a week. So it was that close to a financial meltdown from my perspective. And I think the US government was also concerned enough to actually engage in the QE1, which essentially was replacing all the toxic assets that banking system used to hold with fresh cash. Anyway, so it undermined the very foundation of the fiduciary system, and thus there was a big shock to the real economy, such that over 30 million people became unemployed. That's the first initial shock without the secondary impact actually hitting. About 64 million people fell into extreme poverty, and there's several definitions. One frequent used definition is $1.25 per day subsistence, and if your income is below that, you fall under extreme poverty. And it wiped out over $2 trillion in bank assets. I don't know whether that means anything to you, but it's a lot of money, I can assure you. Okay, so G7, as you know, was the prime informal global process where leaders used to meet to discuss economic issues. G8, which includes Russia to it, was more broad-based usually and included security plus other issues. But G7 was more limited to the core of economic issues. But people soon realized that the scope of the financial crisis was so big and widespread that it was beyond the scope of central bank and finance ministers. And thus the G20, which also used to run in parallel to the G7, became elevated to include the leaders summit. So it was elevated from finance minister, central bank governors level to leaders meeting because it involves so many different aspects of the economy, such that unless the leadership themselves got involved, resolving the issues was just impossible. Since then, there have been several summits, which I would sort of divide into three different stages. The first stage was essentially 2009-2010. The second stage was 2011 to 2012. And the last stage so far was 2013-2014, and that's when I was fully engaged in. Now Turkey, as the chair, is starting what I would call the phase 4. Now let me then describe briefly to you what these different phases actually entailed. Phase 1 was essentially a period where everybody was hectically trying to put out the fire, a meltdown of the financial system. And agreement was thus reached at the very top level, which the United States actually led, how to respond to the crisis. And it was very natural that the US was leading this initiative because the core of the problem was actually arising from the financial system in the United States, and pledged to take forward to ensure non-repetition of the similar crisis in the future. Now, whether the actions taken so far is sufficient, that remains to be seen, because as I'm going to elaborate a bit later, there are signs that maybe another crisis is in the making. The second phase, people thought that now they've put out the fire and they can relax a little bit and start thinking about long-term issues, but then they proved to be wrong, because as soon as they start relaxing, second crisis erupted in Europe. It was actually a contagion that started from the US. Just to give you a very quick rundown, what happened was that the European banks used to get the funding from the United States, and the US banking system was relatively small, but they had a very big non-banking financial sector. And that system was providing wholesale funding to European banks, which they were very dependent on, rather than the non-banking system as in the US. So when the crisis erupted, largely initially starting at the non-banking system in the US, the wholesale funding to Europe obviously stopped, and that was starting to put pressure on European banks, and eventually to the extent that the investors realized that the risk that they assigned to the European banks were mispriced, and suddenly started to reprice the risk premium. And once that began, the European banks' capital was undermined, and thus there was huge banking crisis erupting in Europe. So in order to stop the banking crisis in Europe, the governments in Europe intervened, and they did something similar to what the United States did as what we would call it the QE1, quantitative easing. They essentially replaced various debt that the banking system held with government debt. So in the end, what happened was the banking system was broadly stabilized, but then they ended up with very high debt. And what that did was, then the second crisis, so to speak, within the European crisis was investors realized that some countries in Europe themselves were also insolvent, such as Greece. I don't know, are there people here from Greece? No? Okay, then I can talk freely. Okay, so not only Greece, but there were a few other countries that once investors started pricing the risk properly, suddenly these countries became insolvent, and that sort of started the European debt crisis. Okay, so the G20 was trying desperately to put down a second fire. Okay, it sounded like something like this, and then the third phase was between 2013 and 2014, and that's when essentially, European countries stabilized. They were not repaired. The bank balance sheet was not repaired, and it will most likely take banks another couple of years to fully recover in terms of deleveraging. But anyway, it didn't get any worse, so it sort of stabilized. And so this period, the third phase, was a period when leaders, as well as people like me, were trying to figure out what actually has happened and how we should go forward from now. The biggest difference was interpretation of what kind of problems the world was actually facing. On the one hand, it was led by the United States. They thought the world there was nothing wrong in the world. It's essentially a cyclical, sharp cyclical downturn. And thus, as long as we provide sufficient push through the fiscal measures, we can pull the economy, the global economy, out of recession. Now, on the other extreme was countries like Germany, who thought, well, hang on a second, it's not really a cyclical downturn that we are facing, but it's much more fundamental in terms of structural impediments that we are facing. And thus, just simply providing fiscal space, fiscal stimulus will not pull the global economy out of recession, because the structural issues are so deep-rooted. And between these two countries, and they were arguing at each meeting. And our contribution, meaning Korea's contribution, was actually try to intermediate, but also try to provide some intellectual contribution as to what might actually be happening to the world. And today's discussion is essentially me trying to elaborate what this aspect is and what underlying thinking was actually supporting our arguments at the time. Some of the details, I don't expect you to go through this all, but just to highlight a couple of things. If you look at on the left-hand side, couple of lines below, okay, actually the second from the bottom, it says, putting quality jobs at the heart of the recovery, and then promoting an open global economy. Now, these two measures, or these two objectives, were highlighted during the initial stages of G20 meetings because, as I said earlier, there was very high unemployment, and people thought we need to really provide jobs for them to, get decent life. And also we need to ensure that countries do not become sort of inward-oriented, because they wanted to shield their country from contagion from another country, and thus starting to enforce, anti-trade measures. So there was very strong beliefs that we need to somehow create jobs, and also we need to, ensure that the trade system remains open. But these two ideas were sort of hanging there. They were not a part of a coherent strategy of the recovery itself. And then during 2013 and 2014, what happened was that the the need for employment creation or job creation to be at the center at the recovery strategy became sort of a addition to the G20 process. In other words, job creation was always important, but it was initially hanging there on its own, saying we need to create jobs, right? The third stage, what happened was job creation itself should become a core of the growth strategy that we need to really start enforcing in order to correct the structural problems that we have on hand. This sort of partly explains to you that there was an agreement finally, and the agreement was that we are facing both structural and cyclical downturn at the moment, and it's a bit awkward to explain, but the bottom line is there was a broad agreement that maybe 2/3 of the recession is due to structural problems and 1/3 was due to cyclical problems. Do you understand the difference between structural and cyclical issues? Yeah? Okay, some saying no. Okay, let me briefly describe what I mean. When one refers to cyclical downturn, you think of a simple business cycle. Everything is a steady state situation. There are no inherent fundamental problem in the economy, but due to various reasons, you have these up and downturns. Some people describe it as due to inventory mismatch and so on. But sometimes the economy picks up, then sometimes it goes down, and usually what we call the business cycle, depending on the country background, lasts for a couple of years up to about a decade or so. Okay, and during these cyclical downturns, if you provide enough fiscal stimulus or easy monetary policy, it usually will be able to pull you up. But if you provide too much push, then you will have pressure on inflation because essentially the demand then exceeds supply, and thus your output gap becomes negative, so inflationary pressure builds in. That's sort of is the cyclical downturn. Okay. Now, a structural downturn is much more serious than a cyclical downturn because essentially it's not related to the normal business cycle problem, but it's more that you have a structural problem in the economy, such as a shift in industrial policy, no, not industrial policy, a shift in industrial output preference by consumers, for example. Suppose that the consumers used to prefer commodity A. If they suddenly shift to commodity B, then the industry itself has to shift from producing commodity A to commodity B. If they don't do that, then they have a structural problem, and unemployment will last long until they do this, right? So a structural problem is something that you have to adjust to changing environment from ground on. That's essentially a structural problem. And finally, there was an agreement at the G20 level that maybe 2/3 is due to structural problem and 1/3 is due to cyclical. So the fourth phase then was what Turkey agreed to with the agreement from the rest of the membership put forward was getting out of the global recession. So that's their main theme, getting out of the global recession through, says, implementing committed growth strategies, mindful that it has to be inclusive, to be sustainable, and underpinned by investment and financial stability. Now, Korea's contribution is having actually been successful in including the word inclusive. And I explained to you why that was very important. So Korea's vision overlapped with key thrusts of the proposed agenda in Turkey. And the reason Korea started actually pushing forward this agenda was because the president gave me, when I first took on this job, instructions. The first one was, okay, you have to represent Korea's interest in the G20 process, which was a natural thing, obviously. But then the second task which she gave me was, try to provide intellectual contribution to the G20 discussions rather than just represent Korea and look after Korea's interest alone. That was much harder than the first one. So what I did was, okay, if that's her instructions, then I also follow her through to the end, and then start looking at her economic philosophy. And essentially what that philosophy I realized was about was essentially a remedy to get out of recession that Korea was facing. Soon, and when I actually applied this economic theory to the rest, it actually was a very good fit, because Korea, being part of the OECD country, was very representative of the structural issues that the rest of the G20 countries were facing. And that's how all this strategy came about. So I sent a letter in early 2013 to the chair country at the time, which was Russia, saying, blah, 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 with the objective of reducing income inequality and unemployment, that is job creation. The leaders should commit on something deliverable on the following ideas. Okay, and then it says macroeconomic policy should give due consideration to the impact on income and wealth disparity. So income inequality became a core issue of Korea's strategy, not promoting income inequality, but actually addressing it. And then as a start, countries could review their economies to identify what structural distortions or weaknesses are currently impeding the proper functioning of the market, including issues or impediment distortions that prevent participation of all economic agents in economic activities. So the point that we are coming from was, the reason we emphasized job creation was because we thought that the structural problem was lack of full competition. Thus, there was too much unemployment, excess capacity in the economy, and this the structural problem was rooted in the fact that there was deteriorating income inequality. Okay, so, and that was the first point. And the second point was, there was an increasing evidence that countries were taking advantage of different tax regimes and the ease of which a firm or a company can actually register in one country and do operation in another. So, for example, a very multinational company, a very big multinational company, can register its company in some island where tax rate is zero, corporate tax rate is zero. Then it runs an operation in another country where tax rate is very high, but using the transfer pricing, that it can record all its profits in the incorporate country where tax rate is zero. Okay, and then it essentially doesn't pay tax. That's that's what we call the policy arbitrage approach. So the proposal that we've made is, let's look into cases where there are increasing cases of corporations taking advantage of policy arbitrage. And in the end, that also got traction and led to some measures in the end, which I'll also explain a bit later. Now, let me then become a bit more technical in it, and explain to you what I meant. By the way, how many of you actually have studied economics, so that I just know? Okay, people who never took economic courses? Okay, so it's very easy. So let's start. Let me start like this. There was increasing income inequality, growing income inequality in the world. It has been growing, it has been ongoing for the last 30 years. And people who looked at this found the reasons to be, again, you don't have to bog down into this chart, but there have been globalization was one of the causes, financialization, technological developments, and so on were one of the main reasons why income inequality was getting worse. Okay, now back to this chart. So what was happening was, in the normal, sort of economic cycle, people get wages, number one, right? People get wages. Then wages become income for households. So households spend, And when households spend to purchase products that companies produce, the companies get profit, then they invest in more to expand their productive capacity, and therefore they need to hire more people and wages increase and so on. And this is the virtuous cycle. Okay? Now what's happening is that as wages were actually declining because income inequality was growing, so the share of total profit going to the workers started declining. And as less and less wages were going to the workers, household income started falling. But of course, the economy is a zero-sum game. If somebody gets less, somebody else has to get more, right? And that's the top 1% or 5% who was getting all the money. And I'm not trying to start a revolution here, but it's just a fact, okay? So what happened was that as more and more people got less and less income, because of marginal propensity to consume, in low-income earners are higher than in high-income earners, meaning if you get $100, let's say you have to spend $90 on food and clothing. If you get $1,000, you probably spend maximum $120. So the marginal propensity to consume is much higher when your income is lower. Okay? But as the low-income people were getting less and less, the average marginal income to propensity was getting smaller and smaller. So what that meant was corporations didn't want to invest anymore because nobody was actually wanting to purchase their products. And as they did, they started hiring less people and so on. So rather than a virtuous cycle, now you have what's called the vicious cycle setting in. And that was actually ongoing. But people initially didn't realize that because that process was accompanied by easy monetary policy, which essentially, for example, I'm mentioning the US as a representative country all the time. So, for example, in the United States, the Fed fund rate discounted by CPI, that is the short-term real interest rate, was 0.5%, which was historically very, very low. In essence, people were able to borrow money at almost very, very low cost. So when people started getting less and less, they started borrowing more and more in order to maintain their living standards. And suddenly you have this global financial crisis, and they realized they ended up with two things. One, much lower income because they couldn't no longer borrow from the banking system. And two, they suddenly realized that the money that they used to borrow from banks and spend on consumption was not for free. Okay? They suddenly realized they have a huge debt on their hands. And thus that was depressing consumption and thus deficiency in demand. So what did the United States do? Well, they ensured that people had enough time to get out of this trap, and thus the QE started. And interest rate was kept at zero. So if you have real interest rate at zero, what that means is if somebody borrows your money, it doesn't cost you anything. Okay. If you have negative interest rate, which is actually taking place in Europe, in many European countries, is actually you are giving a person money in order for that person to borrow from you. That sounds good to you, right? But it messes up the whole economic integrity, the system. And that's what's going on at the moment. Anyway, so this is what was happening. So because increasing income inequality was messing up the economy, was overridden by easy money, and suddenly you have this global financial crisis and everything crashed. So if you look at the debt stock in Europe, in United States, in Japan, in major economies, the debt stock didn't actually decline since the global financial crisis. It actually increased in all these cases. But the headline numbers don't show that. Why? Because they show only the headline numbers where the debt actually declined. But if you put the debt stock of households, governments, corporations all together, it's still increasing. You might think, okay, isn't the debt, public debt, different from household debt? Well, yes and no. Household debt is debt that the household has to pay back. Public debt is that the household as aggregate has to pay back. So in this sense, if you're rational, then it doesn't really matter, because then you have to pay it back. Essentially, your children has to pay back. I take it we are not rational most of the time, but if you put everybody together by rule of large numbers, we hope that the economy is rational, right, to some extent. And thus, it depresses consumption. So no wonder corporations are not investing. They're accumulating huge profits because increasingly more share is continuing to accumulate in corporates, and people are getting, less and less wages. And that's the problem that we face. And so thus the Korea's contribution was to argue this case through to come up with policies that will actually address this issue. And that has taken us about 2 years to do. And we didn't do it ourselves, of course. We started having increasingly more countries actually joining in the discussions. But since we don't have much time left, I'm going to skip this interesting chart. So this, what is this? Well, this is, I suddenly realize I have country A and B switched for some reason, but anyway, it doesn't matter. So what it is that, let's suppose that you are living in country B, okay? In country B, you have capital, you have entrepreneurs, professionals, entrepreneurs, and then you have the mass labor. By the way, in normal sort of business environment, college graduates are classified as unclassified, unskilled labor. My apologies, but I didn't make that definition. So, anyway, so what's happening is under globalization, capital was moving from country B to country A. Entrepreneurs and professionals are very mobile, and those who have been to Singapore and Hong Kong will have seen that most of the professionals from all around the world are gathered there, and that was actually one of the reasons why they were able to achieve such a fast economic growth. Okay? So they're very mobile. And then you have the mass unskilled labor, except the very low unskilled labor, who moved from country A to country B. Okay. So what happened then is in country B, you have very high skilled labor who remained because they were able to generate a lot of profit. But then foreign workers at the very low skills came in and took the very low skill jobs. And because of the technological advances, the places for the middle skilled group became increasingly rare. Okay. And so the people with medium skills became dislocated. And that's what was happening under globalization. Okay? Now this is one aspect. And then it is slightly more complicated than this, but this is the most complicated chart in this whole presentation. So if you can stay awake through this chart, you are safe home. So what that means is, let's take country A as an example. You start with raw material, then before globalization, what used to happen is you move on to first stage of manufacturing, assembly, second stage, third, and you produce the final good. That's what used to happen. So within a country, if you had some inefficiency in this sector and this sector, it didn't really matter as long as the final output was competitive enough relative to other countries. Okay? But once globalization started setting in, because of capital mobility and so on, you had some capital moving to this country and setting up the first process here. Once they realized maybe there is more efficiencies there, and then the third stage in country C. So rather than having this whole process taking place in country A, you now have country A producing first stage in country B, and then third stage in country C, and then final product in country A. So what happened? Well, those people who used to work in this and this process became dislocated. Okay, and that's what's happening. And we call this the global value chain. Okay, and this global value chain is increasing very rapidly. For example, in Korea, the total exports about 15 years ago, if we used to export $100, about $85 was value added created in Korea. Now it's about $57. So the rest went here and there. And this is a good thing. I'm not saying it's a bad thing, but I'm just explaining this is the reality. And then unless you become efficient at each production stage, you will face increasingly more unemployed. And this is part of the problem that we face. Oh, sorry, I forgot. This is actually the more complicated chart. So, but if I had to lie, otherwise you wouldn't pay attention. So, now, but because I have only 10 minutes left, maybe I should just be very quick. Okay, this is the household. Okay, now you have these large corporations who are efficient and can move their capital around, setting up production stages in different countries. So as they do, what happens was they became monopsonists, meaning they actually started controlling the price at which they used to buy from their suppliers. Because if the suppliers charged higher prices, they would just move their production base to another country. Okay, so their bargaining power strengthened as the global value chains started setting in. And thus, they became what we call the monopsonist, having market power. Then on the product market, because they became monopsonist, they were very efficient in terms of competition, in terms of price relative to other corporations. And those multinational corporations then started gaining monopolistic competition advantage. So they both had product market monopoly power, as well as factor market monopoly power. And this is why, at the global level, the number of corporations making profit started shrinking, but the size of each corporation making profit became very large. And this is what we are faced with at the moment. Okay. And this here, what this measures is essentially, if you are at 1, that means perfect competition. If you are at 1.4, it essentially means almost close to a monopoly situation. Okay. Now the countries here, and these dots are individual countries, a group of countries, and these dots here are because they are oil-producing countries, so it's natural that it should be 1.4. But for the rest, you can see that in the last 20 years, competition has been weakening and more monopolistic competition started taking place. And this is also supporting our argument that the wage shares were declining, partly because, or in large part because the market was not efficient. We had this globalization ongoing, but the globalization itself was not the main problem, but it was the lack of proper enforcement of the regulatory rules that we had in place that should have prevented monopsonists and monopolists becoming very prevalent. Okay. And the reason that we had these 3 dots almost at 1 was because, obviously, for the reason that large multinational corporations that start actually working off in advanced countries were incorporated in tax haven countries, and thus they in their own countries would look as if they were not really making profit, but at the global level, very small number, increasingly smaller number of companies were making increasingly larger profits. Okay, I'll skip this. I'll skip this too. Okay, so that was and it took me 2 years to convince my colleagues that this is a problem and therefore we need to really address the competition issue. And among the growth strategy that was adopted last year, competition became one of the core measures that G20 countries agreed to implement. The second stage was actually trying to argue that we should also start addressing the cross-border policy arbitrage, meaning competition policies across borders. But then I left, so I don't know what the future will hold. So, in the remaining 7 minutes, I'll touch base on few outstanding issues, just to highlight the fact that the G20 is still very important, because there is no other place that these issues are being discussed. And before I move on to this issue, let me just explain to you briefly how it has actually evolved. During the crisis period, when leaders met, they were discussing on measures how to actually calm down the market, put out the fire and so on. In the last 2 years, what happened was when they met, they discussed about why we have this problem, how we can actually solve this problem. And what actually has happened last year in particular was the leaders stopped reading the scripts that we prepared for them. And that was a disaster for us because we were losing our jobs. But for leaders, what that actually meant was they became very personally engaged in discussions among themselves. And they came up with instantaneous ideas in trying to solve problems. And nowhere in the global process can you find 20 leaders, presidents, prime ministers, coming into a same place for 2 full days and discussing about the global economy, coming to an agreement on the assessment and coming up with a solution. Because when they go back, their ideas will eventually turn into policies. And without the G20, you can't really create this environment. And thus, even though the G20 may appear less visible to the media, and medias are actually off the rooms, they can't come in. I was one of the for each country, they wouldn't allow more than 3 people. So I was, along with the president, the deputy prime minister, myself, and no one else was able to come to these rooms. Thus, the things that gets out to the media is very limited, but I can assure you there is a lot of discussions, live discussions, a lot of brainstorming, ways seeking to find ways to address global issues. And thus G20 remains very active beneath the surface. Unfortunately, I can't really tell you what individual leaders said. But one funny thing is that President Park had to step out because she had a bilateral meeting and she asked me to sit in her chair. So I sort of, sat on her chair, and then suddenly I felt somebody was looking at me from the sides. So I had looked around, just very close table. And it was Putin staring at me, saying, "Who is this guy?" There are a lot of interesting stories like this. And when I used to be the senior res rep in China for the IMF, I met President Xi Jinping a couple of times along with our managing director. And so he knew, because he has seen me at least about 5-6 times over the last year. So when I sat in President Park's chair, he was just sitting across me there. And she looked at me and said, "I've seen this guy, but who is he?" But anyway, I survived, and I'm here. So I tell you, I felt very awkward. So the global financial stability issue, there's still a lot of outstanding issues, and that is, at the moment, the divergent monetary policy going on. The United States, it's now normalizing its monetary policy. EU is now has already started ECB policies. Japan is continuing. So you have this synchronized monetary policy going on. And there is a big question as to whether the global economy, the capital flows can actually take this or not, and what might actually happen. Because there are already signs that things are not looking that healthy. In particular for EM countries, that is emerging markets countries, it is a problem because, again, you don't have to focus on this, but essentially the point that I wanted to make is, if a country doesn't have a reserve currency, what is a reserve currency? Reserve currency is a currency that everybody wants to use for transactions purposes or store of value, like the dollar or the euro. Korea's won is not a reserve currency because it's not convertible. You cannot use outside Korea, for example. But for those countries that do not have convertibility of their currency, they cannot engage in QEs. Why? Because if they engage in QEs, they will face a foreign exchange crisis within a couple of years down the road. Okay, so you have this asymmetric situation where big countries with reserve currency are engaged in QEs. The emerging economies who cannot afford engaging in QEs are facing these huge capital flows, but they don't quite know what to do with this. So once there's dysynchronized monetary policy, the flow of capital becomes very volatile. And so we have still this problem in our hands, and at the G20 this is an ongoing discussion as to how one can deal with this. And then we have this problem. I mentioned to you that we had this problem in lack of rules, market rules, or enforcement of existing market rules. We still have problems with existing market rules. The reason we had the global financial crisis, not because of market-based system, but because there was inadequate market rules or market rule enforcement that was keeping things at bay when they actually started evolving to an area that was very new to the policymakers or the regulators. And I'll give you a few examples that we still have this problem, because if you look at this, and I'm not going to explain to you what VIX4 is, VIX and so on are, but essentially these are all measures of risk, market risk. Okay, so if you look at this period, this was pre-global crisis. And as I was mentioning to you, the risks were all mispriced. You can see clearly the pre-crisis period was the period where the risks were lowest. And there's a clear mispricing of risk. Now we are again in the same regime. Okay. So if I were you, I would put out all my money out of bank and keep in cash. But okay, and then investment grade high yield credit spread. This is the additional money that you have to pay to hold high return instruments. High return, there is no such thing as free lunch. So if you get higher yield, it essentially means you're carrying a higher risk. Okay? But look what's happening now. All the risk premiums are going down, the spreads. Again, mispricing of risk. So we still have this problem of market not able to function properly. And here, even though the interest rates, as I was mentioning, was close to zero, not even though, because interest rate was close to zero, the US, for example, sorry, I have nothing personal against the United States. It's just that I like taking the US as an example because they have the best data available, I'm afraid. So you can see that when interest rate is zero, there is no market mechanism that will actually stop you from borrowing. And they kept borrowing, and that's what I wanted to show. Okay. And here, now this may be a little bit more difficult to understand, but anyway, so I'm not going. Don't look at the chart, just look at me. What that means is that if you have current account deficit because of easy monetary policy, in other words, if a country pushes out money into their system, demand will increase, because people have more money, right? So if people have more money, then demand increases, then they will start importing more. And because they will import more, but cannot suddenly increase their production, they will start getting current account deficit, meaning import is higher than export. Then normally what happens is, once that happens, then the foreign exchange market should be under pressure and the exchange rate should depreciate, so that imported items becomes more expensive and exported items becomes cheaper. Okay, that's the normal economic logic. But if you have a currency that is widely desired, too much desired, then your foreign exchange market doesn't react the way. What happens is that more people want more money, more dollars. And therefore, even though the US was actually engaging in expansionary monetary policy, the current account deficit widened because there was no pressure coming through the foreign exchange market. So the normal economics 101 market mechanism was not working. Okay, and all this, it's still the problem that we have even today. So all this. So the bottom line, therefore, is G20 is actively engaged in trying to solve this problem, but the problem is getting worse. And there's no way to gauge when the next crisis might actually arise. But I didn't want to leave this room saddened or depress you. So I'll finish with one chart that really will enlighten you and have good dreams. And that is this. The top part here was taken picture in 1916, 1920. And here, 2003 and 2007, it's global warming. So the good news is you don't have to worry about the economy in 10 years from now, because before then you will all die, okay? Okay, thank you.